So let's get into the report itself, right? So this year we've actually opened the report by taking stock of what's happened in the past to understand the current situation and also sort of look into the future. Right? The first section of this report delves into the last 5 years of what's been happening in the Indian economy. There's been ups and downs, there's been policy shifts, a lot has happened, and let's actually look at, let's lay that out, right? So if we go back 5 years, the first sort of monumental thing that we have to talk about is this severe shock that the COVID-19 pandemic dealt the economy, right? Yes, this was unexpected, unprecedented, but what's really intriguing is that India was affected the most, right? We were leading the world in terms of our GDP growth, but we were also the worst hit during COVID, worse than the average decline in emerging markets, the world average as well. Our GDP contraction from a FY basis was 5.8%, but from a CY basis, it's a staggering 7.3%. So with this economic decline, the government had to come in and make some very quick decisions, right? This was done in two ways. One was increasing CapEx spending, and the second one was to increase handouts to the public. And this was in the form of direct benefit transfers. There were also subsidy pushes. And on the other side, the RBI started to bring down repo rates, right? And very simply put, bringing down repo rates means that RBI is essentially able to lend to banks and financial institutions at this lower interest rate. That then is trickled down into the consumer itself, and banks and financial institutions are lending to the consumer at a lower rate. And this, more often than not, leads to a credit boom, and in our case this was a personal credit boom. I think Sajith, you'll be going into that a lot more in the next sections, right? But maybe you can set the scene for what this credit boom really led to for the economy.
Yeah. So I think credit boom really meant that a lot of personal loan growth happened, right? And this was also a very interesting period in the economy before that, where we saw banks have a lot of, I would say, NPAs. Anurag, we covered this, I don't know if you recall, in the last year,
Correct.
where we went into this in a little bit of depth. And so what happened is banks, because they wanted to be very cautious about lending to industry, did not grow the industry loan book as much as they should have. And that's what this particular chart tells you of how personal loans have kind of taken on a much larger share than, for example, industry loans. Industry loans actually kind of came down from 34% to 24%, and whereas personal loans really have taken up that slot. So, along with personal, credit, there was also like a consumption boom as a result of all this cheap money policy. And then the next year after that, voila, we saw like a rapid economic recovery. Thanks to the lower base, because we declined by about 5% in 21. The improvement, thanks to the boom, thanks to all the, the easy credit, etc., meant that we went to about 9.7% in growth, so like a V-shaped recovery. And obviously, now when you have a recovery like that, on the back of an easy money policy, what do you think happens when there's a lot of money in the economy? Anurag, do you want to kind of just give me your reaction?
People spend more.
Yeah, people spend more, and there is inflation, right? Like, and that's exactly what happened. Like, we had an elevated inflation rate, and inflation typically is hard on the poor, right? Because typically the costs, the basket of goods that people consume, when the poor consume more food, and naturally the impact there was far greater.
I think there's this other way to look at this is when this aggressive government spending also happened, fiscal deficit was on the rise.
That's right.
And then you sort of have to pump in more money into the economy.
Correct.
There's more money supply, credit boom, again more money supply. And that also on the other end contributes to this inflation rate going up, right?
Correct.
Yeah. So I think at this point, then the government came in and they're like, okay, everyone's had their time in the sun. Let's start reining things back in. And this, at least RBI began this trajectory by bringing these repo rates back up. And within this very short period, because I think from 2020 to 22, it remained largely at this 4%.
Right.
And suddenly between May 22 to September 22, repo rates just shot up from 4.4% to 5.9%. And then you're sort of seeing unsecured loan growth on the decline, right? This also had these NBFCs pull back what they were doing in terms of lending and really driving these small loan books back down. But inflation stayed where it stayed, right? And input costs went up. So what that meant is across different sectors, wage growth wasn't really able to keep up with CPI inflation.
That chart is very interesting, which actually looks at salaries in various industries and compared to inflation. Salary growth over the last few years has not been very good, strangely, like, and or maybe not so strangely. There are structural forces there. And what is really meant is that inflation's kind of stayed even despite the RBI's efforts on the repo rate. It didn't come down as much as we expected. A lot of that was structural, I think. Food inflation, etc., was high. And the result was weak urban sentiment. And we've been talking about urban growth slowdown. And you can see that in the data here. And but interestingly, rural wasn't as impacted, and that's thanks to the monsoon and handouts. And that's actually a very interesting chart on how all of these women-friendly handout policies, some of it inspired by the need to kind of win the election, has seen a fair amount of money going into women's hands, and that goes into the household. So two charts that kind of illustrate this, and then finally microfinance also matters. Microfinance growth means there is more money going into these households. Some of it finds its way into consumption. So that's really
interesting that this wasn't greatly impacted by repo rates going back up, like the microfinance growth.
The time period we have selected till now, yes, but subsequently, we haven't showed that here, there has been a slowdown.
Post that.
There has been a slowdown post it. So the story of microfinance is that FY25 onwards, there's been a decline. Which we haven't shown here.
But essentially what you guys are saying is that there was a shock because of which we increased the money flow that has resulted in all of these crises, and then we are reining it back. Is that the net end of the story?
So TLDR is as follows: COVID shock, decline in economic growth, rapid response on a dual prong, increased subsidies, increased DBT transfers, and the RBI lowers down your repo rates to make it cheap. As a result, easy money leads to a credit boom and a consumption boom. Also, there was a stock market boom, remember? All of those good sentiments. But the party can't hold for too long. At some point, inflation sets in, and then, of course, the government now knows it's heading into an election year. It needs to rein it in. RBI is also worried about unsecured loan growth going at a rapid clip. So the result of this is a reversal of the easy money policy, and that leading to because of stubborn inflation, leading to poor urban sentiment, but rural keeps the party going on for a little longer. So actually, slide 18, and it's kind of interesting because there's this chart which is fascinating because for the first time in India, FY24 actually saw a divergence between consumption growth and I would say GDP growth. It's very rare because 3/5 of the Indian economy is led by consumption. It is very unusual. I don't know if it's ever happened before to have this divergence, wonderfully captured in this chart by PNB. And as you can see, so when consumption goes down and the economy doesn't go down, so there's another force, and that force is really the government spends. And the government CapEx spends kind of kept the party going, and that thanks to that we had an 8% growth last year, despite consumption growing at just 4%. But then we entered the election year, and then post-elections, after the government had a narrow, I would say, majority thanks to the coalition, etc. They were able to kind of address the fiscal deficit, and what they did was really reduce the spends. And the result of the reduction in spends has been a tapering of the growth, because consumption is down, spends are now government spends are also down, and then you finally kind of settle at the lower growth rate. So this year we're likely to end at around 6% 6.5% or so, much below last year's 8.2%.
Understood.
Not bad, but not great. Okay. Time to now look into the next section, and the next section is an interesting one, where what we've tried to do here is take and list about 9 what we call long-term structural forces which shape the Indian economy. And these are not exhaustive, I think. There might definitely be 1-2 more forces we've left out. But we believe that these forces, these long-term structural forces and their interplay shape and explain the Indian economy well. And what I'll do is really cover a few of them. Then I'll try and bring in Anurag, who's been waiting for a while now to kind of speak his piece. So the first one really is to give an overview of how the GDP of our country is shaped by consumption and services. Chart's a wonderful way to kind of understand the building blocks of our GDP. 2 ways to look at it. One is through what we call the expenditure component, which is really that GDP is a sum of consumption, investment, government spends, and exports minus import. That's trade. So there is this formula called C plus I plus G plus X minus M, which is consumption plus investment plus government plus exports minus imports. That's a handy way to look at it. And what it really tells you is consumption dominates with 56% share. And the other way to look at it is to look at really in terms of services, industry, agriculture. And what's particularly interesting is industry in India, unlike let's say a Korea or a China, is much lesser than services. So India is almost like a first world country in that respect when you look at it. So that's what. The next few slides kind of go a little more deeply into an explanation of these and an illustration of these. It fundamentally says that we've always been a high consumption nation and a lower investment nation. And one reason for that really is the savings rate. Again, we will dive a little more deeply into the savings one, but it's really a factor. This chart, which is on how services sector dominates the Indian economy, is one of my favorite charts. It's actually, what's kind of interesting is, while services is our biggest sector, Anurag, guess which is our sector by employment? Like, do you want to take a guess?
I would take the right guess now because I've worked on the report, but my natural guess would be manufacturing or agriculture to be the biggest labor force provider.
Yeah, you're actually, well, you covered both, but manufacturing is what a lot more people would expect, and it should be ideal for the Indian economy to have a higher manufacturing share of the labor force. Because all of the countries which have gone from an underdeveloped profile to a developed profile have gone through moving people from the agri segment to industry. But India is one where we seem to have skipped this completely. And that is sort of something that we should will cover in your manufacturing sector, I presume. We'll cover some aspects of that. But fundamentally what it really says is that services, which is about just over 50% of the economy, employs less than a third. Agriculture, which is about a sixth of the economy, employs nearly half. And that's a lot of people who are not very productive, right? And so the industry, which kind of comes in the middle and is really about a third of the GDP, but employs about just under a quarter. Okay, so we should ideally employ more. what I particularly found interesting was that in industry, again, there are sub-components.
Yeah.
Manufacturing is only one. Construction, in fact, is very high. About 10% of the labor force is construction in India, which is all the people migrating and working on these housing and buildings, etc. So that was particularly fascinating.
But that's not isn't that a natural flow of a developing country to have a very huge workforce in construction?
Yes, I don't think it's particularly surprising. What was surprising is its relation to manufacturing. That it's 10%, about 9-10%, and manufacturing is only 17%. So manufacturing being low is a real.
Okay, got it.
It's a real surprise. Yeah. So and say services. What is particularly interesting is really in services how services exports. Our services exports are about 5% nearly of the world's global service exports. That was particularly fascinating. Led by clearly IT, ITES, professional consulting services as well, and sectors like that. Now, my only one worry on the services front, and when I say only one worry, it's a fairly big worry, is about AI and what AI could do. And maybe next year, like it may be just our avatars are kind of talking about this, and we may just need to give a few prompts, and our avatars could kind of do this report.
Yeah, I think the amount of AI tools we used this year to actually build the report itself, like, really sets the tone for what's coming.
Yeah. I've been giving credit to Claude as a fifth member
of this team.
Yeah. So, pause then move to this next theme, which is really about formalizing and really about how the economy is moving towards getting more organized. The branded part of the economy is increasing.
Yeah.
Okay, so that's really about the next segment, and there are some wonderful charts which kind of illustrate this. So one of my favorite charts in the formalizing section was really this chart on how the Indian jewelry market is shifting from a largely unorganized. In fact, 20 years back, the organized sector was just 5% of the jewelry market, and today it's as much as 40%. So that was particularly fascinating because given all of the weddings and given all of the black money we talk about, you would expect the jewelry market largely to remain unorganized. But this was particularly interesting.
But curious, but why is formalizing important? Like, why is it a structural force?
Yeah, good question. I would say it's a structural force, and because formalizing is how you bring more people into the fold of the state. That is, you are able to tax these services and you are able to account for these services. And for example, let me talk about two things. One, having more people get taxed either through GST route means like business can get more input credit for things like that. More money comes into the government's coffers, which you can use to kind of spend on maybe subsidies or on CapEx, etc. On the other hand, workers, when they're part of the formal economy, get benefits, for example, get PF, etc.
Yeah.
So
Understood.
it's ideal as the country grows to have more and more of the economy come into the formal fold, which is finally happening in India. So that's good to see. The third theme is a little bit to do with savings, and here I want to kind of talk a bit about the savings rate. And when we looked at India's gross fixed capital formation, or why India's investment is low, I alluded to the fact that our savings rate is low. And as you can see here, savings rate is about 30%. It's not particularly low when you look at, for example, the West, but it is low by Asian standards. And fundamentally, a lot of that, as we've seen, we've kind of dissected this a little more, it's happening in detail, is fundamentally led by lower financial savings. Physical savings have kind of stayed constant, but low financial savings are led by high rise in liabilities, borrowings. And what we are seeing is the borrowings are actually growing fast. India's household debt, which used to be in the late 20s, early 30s, is now 40 to 43%. And much of that is non-housing debt. Housing debt would have been still understandable because finally it's like, for your house, but non-housing debt is high. Why is non-housing debt high? Because we've had a huge rise in personal loans, especially small ticket personal loans.
The one which we covered in the first section.
Yeah, and also last year, we covered this last
Yeah.
year, which you worked on. And much of that is led by NBFCs and fintechs. And so that's really the story of savings. And I think it's time to bring you in, Anurag. I'm going to let you talk.
So broadly speaking, so the way what Sajith said, that there are 8 to 9 structural forces, I will be covering 3 of them. One is basically the equity and F&O market. Then there comes the land and gold, the unique relationship India has with gold and land, and the third being manufacturing. I feel let me just get started on the equity and F&O part.
Sure.
So like I was saying, so equity and F&O, I think the best way to understand it is a retail participant story in the public market. So there are 2 parts to it. One is equity and the other is derivatives, and we'll cover them. But broadly speaking, like a very high level overview of the story is, even though that Sajith mentioned that we are saving less, but more of our savings are going into equities. So let's say 10 years back, it used to be 3% of household asset. Now it has become 6% of household assets. And that the main growth that we have seen in equities has happened in the last 4-5 years. And all of us know that. All of us know that all of our friends are putting more and more SIPs, all of those things have happened. And we can start seeing the impact of that. So let's say for 2024, the big story is that foreign institutional investors have been constantly selling. They're selling left, right and center. But our markets have not performed that worse off. Like let's say if it would have happened 5 or 10 years back, it would have impacted the market a lot more. And that the impact that you can see is very beautiful. Like sometimes when you look at charts and you're like, boss, that tells a very strong story. So one of them is like, let's say if you look at 2016, the DII to FI ratio was twice. So FIs were 20%, DIs were closer to 10%. Now they have come closer to a less than a percentage of difference. So that means that DIs have kept on increasing their stake and FIs have kept on selling. And like that's like such a beautiful chart to look at, and you can also see, like let's say last year Indian DIIs, that's basically mutual funds so to speak, have put in about 5.2 trillion rupees, which is like in 4 years back, I think if I'm right, 2021 or let's say 2019, that was 0.4 trillion. That's like 13x increase in less than 5 years.
So just to contextualize, a trillion trillion rupees is roughly $12 billion. So 5 trillion rupees would be what, $60 billion.
Correct.
Yeah, go on.
Correct. And that's just amazing. And now when you look at like how is it coming from, more than half of it is coming from SIPs. So that's like a very interconnected part of it. Like the retail investors, their enthusiasm is driving the market and it is keeping it stable. But now the problem with retail investors is that you don't know till when will it last. Like let's say the returns start dropping. Do you think retail investors will still start putting in money? I'm not sure. Like in other markets that have not been the case, and people are worried. Like other Jeffries, all of these houses are worried that how much longer can DII last. And one, let's say, quirky data that I can share is basically, let's say if you look at SIP cancellations rate, that has increased to 64% in FY25 versus let's say a 52% last year. That just shows that people are more hesitant, people are more...
So you're saying 64% of SIPs registered are getting cancelled, or the ratio between cancellations to registrations is 64%.
Correct. You're right. Registration to cancellation is 64%.
Got it. Yeah.
And that just goes your directional sense of, okay, people are more hesitant, people are more cancelling, but don't get me wrong, the momentum is strong. DIs are still putting in money.
But maybe, do you think this also has to do with the fact that yes, there are a lot more retail investors, but maybe their financial literacy isn't where it should be? Is some of it also like fear-mongering led selling, rather than the investors' own sort of understanding of the markets?
Correct, and I think you've given me the perfect segue to the most exciting part of the report for me. That's calling.
Other sections are going to compete for that honor of the most exciting section. Wait till Q-commerce. Yeah.
But this is, I can call India's derivative market, like the gambling nation of the legalized gambling way.
Alright.
So
Okay.
it's just beautiful. So let's say if I say that India is world's best in something, you would assume that it is best by a margin, it is best by, let's say, 10%, 20%. But India is the largest derivative market. Not just largest, it is, I think, 20x large or something like that. So we are doing 155 billion contracts last year versus, let's say, US, which did 7.4 billion contracts. So that's humongous. And much of it is coming through a system what is called as index options. So if I have to give you a very simple explanation, so let's say if you go Nifty 50, you just buy an option that, okay, next week Nifty 50 would be at this price. And you take a put option or a call option. That's what is driving most of the market. A representation of that could be, so let's say in FY19, the turnover of index options was about 7% of overall trading. So let's say 1 lakh crore worth of normal stock was bought that day, 7,000 crore of index options were traded. Today,
As an example.
Today that's more than 50%. So if 1 lakh crore of stocks are bought, 50 to 60,000 crore worth of options are traded in that single day. The premiums are paid on that.
Wow.
And that's not even at the highest. At the peak, it was closer to 1:1 ratio.
Crazy.
The charts will give you a better understanding. I'm just giving you a very understanding that, okay, that's become huge. But the point is, and the funny part is that even though we are so huge in terms of contract sizes, people hold contracts for much, much smaller amount of time. That means that I am holding it only for a day or 2 days. I'm just buying it and selling it. That shows you a very speculative nature of what is happening in that market. One very fun fact would be, let's say 73% of all index trades happen on the last day of expiry. So let's say if today my index option is going to expire, the weekly expiry is happening, I'm trading the same day. The reason is because it is cheaper. It will cost you less money.
So are these really, they're clearly not long-term investors by a mile, but are these really even investors? What is your reading of the scene? Or are these conversations that you don't want to have on camera?
I just love these, everybody has seen them. Like, let's say Insta forwards that comes, Insta reels that, okay, I'll make you 1 crore today by trading in that option and all of that. It just shows you that impact. And it also ties into the story of retail participants coming in. This is also, again, a retail story. So let's say there were about roughly 700k or 7 lakh people trading in futures options in 2014. Now it is 11 million. And that's massive. And the best part or the funniest part is that all of them, 90% of them lose money. It's like charity, but the rich is getting richer, the poor is getting poorer. And this is like a SEBI study that I think a lot more people should read about it and get their own understanding. Like, there's so much data to it. Like, people are losing money, more low income people are participating in this. And the funny thing is that 40,000 crores is what was lost by retail investors in FY24. And almost equivalent was made by prop funds like Citadel and all of them that year. So basically, I'm losing money and a prop fund, algo trading fund is making those money. And that's what makes people worried. That's what made SEBI worried, right? Like, why is that happening? And you can see them also panicking on that, and they took steps. I'll not go into the steps they've taken, but essentially what they've done is that they made it expensive for you to do speculative trading, which has made that impact. So let's say the volumes have gone down by 50-60% from the peak of November to now December, and it is going continuously. It is stabilizing. It is decreasing month over month.
Do you feel for next year we're not going to have the 20x size of the US market chart? Do you think that's going to come down significantly?
But I feel we'll still be largest because we're largest by such a big margin.
All right. I also wanted to say I kind of loved some of those tweets, and finally we went with 2 of the tweets. Really loved the tweets because those tweets tell you a dramatic story where people are actually investing a substantial part of their salary, and that was really interesting and surprising for me to kind of read. Yeah.
I think the only chart missing here is the number of ads we used to get for F&O courses before versus today from these finfluencers.
Yeah. No, that's okay.
And the other chart left is my P&L balance.
Yeah.
So
In general,
also is not that great.
In general, I'm not a big fan of government regulation, but I would say this is one regulation that's welcome. Like, controlling influencers, controlling the F&O trade, which to me is almost like legalized gambling, as you rightfully mentioned. Well phrased is big. Yeah. So what else do you have for us? Yeah.
Correct. So this is one section that we covered. One more structural forces, land and gold. Now, I like to take credit, but this is essentially a section that Joseph, who works in our fintech team, keeps talking about, very passionate about, and that's why we have included it. And it's a story that you don't really understand intuitively, but once you hear it, you're like, okay, yeah, that makes sense. So the story is very simple, that Indians, everybody, all of us, all of our families have a very special relationship with gold.
Oh, tell me about it.
We buy a lot of gold. Everybody, we are the largest jewelry market in the world, but we are also the second largest consumer of gold. Be it jewelry, be it coins, be it all of those savings instrument. And it is the second largest way we save after properties.
That's right.
And that has been steadily there. It's not like it is reducing. It's about 16%. And for context setting, let's say if last section I was passionate about equity. It's 3x of equity. So let's say if we save 6% or 5% in equity, we save 15 to 16% in gold. And it has very funny consequences, like the current account deficit consequence. We buy so much that we just don't, we export so less compared to how much we buy at times. So that creates a very funny consequence. But the meaning that I'm trying to get to is that gold, why do people buy gold? Except cultural reason, is because it is a very good source of collateral. It's a very good way of saving. So let's say if a farmer is earning $100, he can keep on saving that much amount of money and buy some gold and keep it with him. It acts as a very good collateral. Somebody is willing to.
I remember having this conversation with Joseph, and I think he illustrated it wonderfully. Like a farmer goes with his produce in lorries to the nearest mandi, he sells it. And now he gets cash by the bag full. That's a lot of cash to carry. But and what he can do is he can go with this to the nearest jeweler, convert it for like a few tolas of gold, and then carry it, very easily. So this and the other thing is, and he can keep this gold with him, and anytime he needs this, he can go to a money lender or he can sell some of this. So it's actually an incredibly elegant tool which addresses so many jobs to be done.
Correct.
Right? It solves a transportation problem, it solves a collateral problem, and it's a convenience problem that is addressed, etc. Yeah, go on.
Correct. You've given the advantage. It's very easy to carry, it's very good as collateral, and it also depreciates in price. It's not a depreciating per asset per se.
Yeah, have you been reading about the gold bars that are being moved from London to USA? You should read about the gold bar.
London to India? Or London to USA?
London, USA, actually, right now, because of what Trump has been doing. But that's anyway a different topic. We won't get into that. But yeah.
We'll need another report of 180 pages.
We'll call it the gold report. Yeah.
So, getting to the point here, so essentially because it's a very good collateral, what happens is that, why is it? Like when you ask yourself, why is gold such an important collateral? Why is it not there in other countries? And the answer is because land is a bad collateral in India. Bad is Anurag's way of saying, I don't know whether it's that bad or not, but essentially the data points that you look at, right? Mortgage to GDP ratio, India is at 11% versus let's say US at 110% or South Korea at 60%, or sorry, 50%. But the moreover point is that because you cannot give land as collateral, you have to use gold as collateral. And the reason can be multifold, but one or two reasons why land is not that great as a collateral is because of the less amount of contract enforcement that is present in India. Like there are two data points. Like one is that average time to enforce a contract in India is around 1400 days, whereas in global average it is 350 days.
Yeah. So here what's interesting is, I remember having this chat with someone, and it's also that India has a disproportionate amount of cases devoted to land issues.
Correct.
Right? I think, I don't know if the data is there, if you're able to get that data, but I think India
66%.
66%
of the cases are related to land. There are about 47 million pending cases.
Oh.
And about them, 66% are estimated to link to land.
Got it. So 2/3 is linked to land. And I think one of the funny things is there is a small section on addressing which comes later in the report, and that comes in the Indus Valley playbook section. And there's a lot of addressing issues when it comes to land. Addressing as in the correct address, and so land parcels are lot often misidentified. It sometimes has two owners, and it's a nightmare to kind of get the correct parcel identified, etc. So that also plays its part, I would say.
Correct.
Right? And sometimes people do it intentionally also, give it two different numbers, etc. So I can completely understand why land is not a efficient collateral, but I would never have guessed that gold is an efficient collateral because land is not so efficient in India, right? I would never have guessed that.
Correct.
So I think that's an interesting insight from Joseph.
Correct. And the net insight is that because you cannot take loans against land, that's why people save in gold. That's the beauty of it. And there are second order effects of all of these things.
Clearly. Yeah.
So that's why it's a very strong structural force.
Yeah.
So third section, and then I'll hand it over to NS, but basically what we're going to talk about manufacturing. And I feel manufacturing is one thing that came as a very striking or a thing that I keep on hearing about from people, but never really understood. So my understanding is that manufacturing is the driver of a developing country, and that's the only way you will get developed. So India needs to be very good in manufacturing to get there. And the story that we started to, when we started reading, and that's a story that came out, is that okay, something is happening, but I don't know whether that's enough or not. So let's say for context, India's manufacturing share of GDP is at lowest, is at equal to 1960s. So let's say we are about 12.9% of GDP. Like let's compare it to China, that's 26%, or let's say Vietnam, that's 24%. So basically we are lagging behind in manufacturing, and that's because of three reasons, and that's a very cute way of saying labor, land and capital. These are the three reasons why we are lagging. So in labor, the percentage of skilled labor is far lesser in India versus everywhere else. Now what it means two things. One, it is harder to get skilled labor. Second, the labor that you hire is also expensive. So if you look at the chart, 2.3% is India, and then Germany is 75%. All of that shows that, okay, don't go by the percentage, but just look at the magnitude of it. Basically, we have less amount of skilled labor.
Yeah. The gap is incredible, and maybe it's improved since then, and I guess
correct,
as with all stats that you'll have different numbers, but fundamentally what you're saying is we have a skilling issue when it comes to labor. So it perhaps is that our labor is cheaper. It could well be that our labor is cheaper, but the productivity will not be as high. Okay, and you can't use them for very high-tech stuff.
Correct.
And so that has its own challenges as well. But strangely, we also don't have a very big low-tech manufacturing sector. Textiles is still hasn't fired as much as like a Bangladesh has.
Correct.
So but back to you.
Correct. So that's basically labor. That's what you have encapsulated. And there's land. Land is also saying that okay, doing business in India is difficult, and this also comes from an unease of doing business article on Bloomberg, but effectively saying that okay, land is 25% more expensive for the same thing that you're building in India versus Thailand, and also the amount of government cost is also much higher, 25-30% higher when it comes to comparing Thailand to India, which effectively makes the cost of a project much higher. That's like the problem with land per se. And there's capital, so you need capital to build a business, grow a business. If the capital available is more expensive, you'll automatically be more conservative, and you automatically won't do that many number of things. So that's also seen very starkly when you look at India, that's about have 12 to 15% of SME prime lending rate, versus in China that's about 3 to 5%. And
Do you think this has, sorry, do you think this has anything to do with that residual trauma of NPAs, right? Would that play any role here?
Oh, interesting. I would say that the residual trauma of NPAs, is an interesting way to put it, is reflected in, I would say, the low share of GFCF from the private side. It's beginning to change now slightly. Private sector started investing, but otherwise much of the GFCF burden is borne by the government, which has other implications as well. But I would say it's not directly seen here, manufacturing, sort of an indirect way.
Yeah.
But yes, the private sector doesn't invest as much in fixed capital creation, and that also means that the manufacturing sector doesn't get the benefit of that. So these are interconnected, but not as directly.
But a bigger reason, I think, is the bond market has been crowded by the government, which creates lesser room for you to get cheaper amount of loans for SMBs and all of that.
That's a good point. That's also reflected in the SME lending rate, right?
Correct. Yeah. That's like one big driver. So basically, that's the problem. Now, what is India doing about it?
And just to make it, we spoke about the low savings rate. Now, look at the impact of the low savings rate. The low savings rate of the people, low FDI, which is less than our remittance, which means that capital is expensive, and there isn't enough from the private sector. The private sector is scarred and banks are scarred by what happened. They're not lending as freely to the private sector, which means the government has to kind of get in and do everything. Because the government has to come in and do everything, there's less capital to go around, they crowd out. So it's sort of very interconnected. And but I think we should get back to land, labor, and now what? Capital?
Land, labor, capital. Now these are the problems. Now what is India doing about it? There are three things that India is doing about it, and it's a very systemic thing that they're doing. One is that they're banning import bans. That's one way to improve manufacturing. So let's say defense equipment, you cannot import it, you have to manufacture it. Then it comes like there's import ban, then there's tariff. So you apply tariffs to anything that is coming from abroad. And you can see that though you would say that China has tariffs, but if you look at India has 11% versus China at 3 to 4% at times, 3 to 4% or 5% at times.
You use the T word, tariffs, and I want to use another T word, which is Trump. Not surprising, right? That Trump had to call out about India's tariffs, etc. I thought that was fascinating, but back at you.
So that's first is import ban, second is tariffs, and the third is basically incentivize. You incentivize doing some good behavior. So that's basically where electronic exports, where you are saying that you will give 33 billion over the next 5 years to 14, 15 sectors. So that's the way you will do it. And on the tariff part, I feel that's one way that a country can grow its manufacturing base. So these are three very good ways to do it, and you can see that effects. So let's say for the import ban, you can see in room air conditioners going down from 45% of imports to now 5% in FY23. Then you can see the electronic export has gone from around 4.7 billion, let's say FY19, to now larger than 37 billion. So it has grown massively. You can see iPhones also, there was a stat, I could be wrong, but 10% of all iPhones are produced in India. All of these things show you that India is starting to build its manufacturing muscle in electronics. And you can also see the thing about import bans and all of that in toys as well, where there is extra subsidy, like the subsidy, the imported toys were being charged 70% of tariffs from 20%, and that has caused us from being a net importer to a net exporter. So those are the three things that you see. There are many more examples to show you that India is moving towards manufacturing, but at the same time, the bigger question lies how far. Anything is good when you look at only that particular thing, but when you look at a macro lens, when you compare it to different countries, then you ask your question how well are we doing? So one way to look at it is that China plus one is an emerging theme. It has been a theme for 5-6 years. Basically, people are offshoring their manufacturing away from China. But is India getting the maximum benefit out of it is the question. Our answer is that maybe it is getting, but a country like Vietnam is getting the 3x of benefits what India got. So let's say as a number, India has gone from 54 billion to 87 billion between 2018 to 2024.
This is exports to US.
Export to US versus Vietnam going from roughly the same number 49 billion to about 136 billion.
Wow.
So they are getting a very stronger or a much more stronger benefit through China Plus One strategy.
Got it.
Yeah.
So that's like a broad thing that I feel is the manufacturing story.
I think what's interesting here is also this ties into what we were saying about these labor-intensive manufacturing subsectors, right? That's where we seem to really be falling short.
Correct.
Vietnam seems to have done much better on this labor-intensive manufacturing side, probably again to do with that skilling differential that we also
if you look
discussed.
at leather, footwear, apparel, it's been disappointing. Gems and jewelry, which is still somewhat labor intensive, has a good share, but that apart, nothing is done very well.
So just to kind of do a TLDR, Anurag, so sense I get is that manufacturing share of gross value added or GDP is at a historical low, strangely, and much lower than like China or Vietnam, half of China, because of land, labor and capital issues. To address this, the government is looking at bans, tariffs and incentives. So there's been progress thanks to that. But it's been not as impressive a progress as say Vietnam has made.
Correct.
Yeah.
When it comes to at least the China Plus One strategy. So that is still yet to kind of deliver tremendous results.
Correct.
I think it's a good place to kind of wrap I think manufacturing. And I think Nachu, now you have something for us.
Yeah. So I'll actually pick up this next section from how Anurag started off manufacturing, right? Manufacturing is sort of a big part of any developing economy story. And the backbone to much of that manufacturing is the labor landscape and the human capital on the back of it. So this year we actually dove into India's human capital situation, and let's kind of take stock of this, right? So first let's try and look at the labor landscape itself. If you look at the working age population, right, this is people over the age of 15, that's 961 million individuals. And then there's the workforce participation rate, which then brings this number down significantly to 578 million individuals in the workforce. And there are some nuances to this workforce itself, right? If we start breaking this down, we actually get the sense of informality in the workforce. Much of the workforce is self-employed. 58% of the workforce is self-employed, and 1/3 of that cohort is actually unpaid helpers in, say, a family business or household enterprise, right? So
that high, is it?
That high. So
Unpaid.
1/3 essentially don't have agency but are self-employed, right? Then there is your set of casual workers, again not a formal form of employment. Then you have regular salaried workers, which is only about 22%, but even this has a nuance. There's 13, so if you break that 22% up, 13% is actually regular employed individuals, but without a job contract. So they don't have social security, they don't get paid leave. And only 9% of regular employed individuals actually have a job contract, right? So there are these nuances. And then of course there's unemployment, which is 3.2% of the workforce. But I think we should also understand how we define unemployment by usual status in India, which is anyone who's worked 30 days in the year, right? So I think there's a lot of leeway there to how you really understand that. And this formal sort of employment is much higher in some of our peers, this regular employed individuals, regular salary employed individuals, right? If we look at Russia, it's 93%. China is 54%. Bangladesh is actually 42%, still higher than our 22% considering even those without a job contract.
So if I look at this fascinating chart, and sure, some numbers may be here and there, I'm sure, because you had to kind of really piece this together. What it tells me is that of the population of let's say 140 crores, 1400 million, less than 10% has a regular salary. But
Yeah.
and less than half of that 10% has a salary with a job contract.
Yeah.
The people like us. So it's only when you have a regular salary with a job contract that you can get access to secured loans and stuff like that, right? Which is why we're also seeing, for
Correct.
example, the rise of unsecured loans, why gold matters, right?
Yeah.
So all of these are interconnected,
Yeah.
and I think it's a particularly fascinating chart to really understand the challenges that we kind of have in India. We'll have to kind of move more and more people and into this 51 million, and 51 million has to become one day 510 million,
Yeah.
right? Hopefully,
Yeah.
like, but
Yeah.
but over to
Yeah.
you.
No, if we go by the 140 CR number, right, actually it's much lower than 4%. Because it's 9% of the labor force, the
That's true.
workforce. So
That
it's
is true.
significantly lower, which is sort of an interesting way to look at this. And I think after setting that context, we also have to look at some of the structural challenges we face, right? And we've covered this in some of the previous sections, and I will sort of highlight it again. One is this problem of disguised unemployment, right? Largely to do with agriculture. Sajith, you pointed this out. 46% of jobs are in agriculture, but contribution to GDP is only 15%. So a lot of unproductive assets there. Then, Anurag, we discussed manufacturing and how a lot of our manufacturing is more high-tech manufacturing.
Correct.
So, capital intensive, right? If we break down manufacturing growth into its subparts, a lot of the growth is driven by capital infusion, not by labor infusion. Again, this has to do with, like the low prevalence of lifestyle.
Chart's interesting. So the blues really is about capital,
Yeah.
and sort of so that's that, and so much of the manufacturing growth is led by this blue portion,
Absolutely.
and not the black portion,
Yeah.
which is labor.
Correct.
Right, and it's kind of reflected. It's interesting. So while India has a lot of unskilled labor, and we're not able to get those industries moving where they could be utilized, like apparel. Strangely, we seem to be very strong in industries
Yeah.
and sectors where we need far more skilled
Correct.
labor, and so it's particularly fascinating. But go on.
Yeah, I think also maybe slightly to do with how it's hard for us now to compete in labor intensive sectors, because we see Vietnam's prevalence in that market. We're seeing Bangladesh where the wage is actually much lower than for an Indian laborer, right? So maybe that also sort of contributes to this. But yeah, another sort of structural challenge, and this one is very paradoxical. The higher a person is educated in India, the higher the likelihood that they are unemployed, right? So if we look at this chart, which one of our more depressing charts, I would say. If individuals who are educated below primary level, their unemployment rates are only 3.2%. But a graduate with a degree who spent that money, gone to school, 28.7% is
So
the
more than a
unemployment rate.
quarter of graduates are just unable to find a job.
Yeah.
Okay, that's
Difference
yeah,
is 9 times between below primary education
Yeah.
and graduates. And I think a good way to understand this is that Indian graduates, they want what we've termed as AC jobs, right? They'd rather be unemployed than work in non-prestigious jobs, right? And much of this interest for these prestigious jobs is geared towards government jobs, because there you get this holy trinity: prestige, you get job security, and you get higher pay. Karthik Muralidharan, in his book Accelerating India's Development, right, he has a very interesting chart there which talks about how government school teachers make 5, even 10 times more money than private school teachers. So this also tells you why the gearing is towards government jobs. And
So on that one, it's particularly interesting since you mentioned about disguised unemployment in agriculture. The disguised unemployment here is in the government jobs exam preparation. People taking years, and you're in the preparing for government exam. And it's sort of a very convenient, socially acceptable way to say I'm unemployed, right? That I'm preparing for a government exam. In the first Indus Valley Report, we had spoken about the 3 E's. Exit, exam and English as the routes to progress in India. And India is a particularly fascinating country because all government jobs have an exam component. And for some of them, people spend years preparing for it, right? And it's sort of sad. So that's the other kind of parallel to disguised unemployment in agriculture. It's a disguised unemployment of the Indian youth who's preparing for government jobs. So I'll bring it back to you.
Perfect. Yeah, I think this is a good segue, the exam segue into sort of our underinvestment in human capital, particularly areas of education. Education spending as a percentage of GDP, we've in this chart sort of compared India versus peers. It's not looking great. And then there is this larger report that we uncovered. We can maybe even leave a link into that, right? But just some key elements that come out of this is that in the early 90s, in the early 1900s, India and China were in similar footing in some sense, right? But China took this very differentiated approach to their education policy. They focused on primary education with a focus on improving literacy in the country. India, on the other hand, focused on its elites and it focused on tertiary education. So China did primary education, they focused on vocational training, they focused on skilling, all of these. And what that manifested in is that a lot of the Chinese graduates actually went into technical areas and technical fields of study, largely engineering. And India, on the other hand, a lot of students went into, again, humanities, law, business, with the focus on getting what we discussed before, government jobs. Right, so this created this rift in skilling in some sense as well, and we sort of brought back that previous chart on formal skill training between India and other peers, right? And a big question here has been about India's demographic dividend, which has been talked about quite a bit, and whether we're capitalizing on it. So our demo dividend started in 2018. So we've had roughly 7 years in demographic dividend. So we decided to compare this to other economies' first 7 years of demographic dividend. The average GDP growth rate, China, Korea and Japan during their first 7 years was over 9%. In India, it's about 5.6%. Even Bangladesh, which started their demographic dividend at the same time as us, they're seeing an average growth rate of 6.3% or so, right? And I think it is one of our unfair but relevant comparisons because of sort of the impacts of COVID. Yeah. But one worth noting. And the second part of this is also, I want to pose this question of whether there is really much weight to having a demographic dividend in the era of AI, right? Because you don't need as much labor capital as you needed in the past to drive productivity, to drive growth. So again, I think two repeated themes here are Trump and AI, but yeah.
So yeah, AI is a threat. And we have this quote by Shankar Sharma, who's always giving these provocative quotes. But he actually says, is AI going to reduce India's demographic dividend into demographic dust? It's very, very provocative, but yeah.
Yeah, I think maybe we'll get into something a little bit more upbeat. I think that was so let's, I think we've covered India's DPI initiatives in the past, right? In all of our reports, because it's such an important part of governance in India, digital governance. We sort of lead the way on that globally. So this year we thought, okay, we had these initiatives for quite a while. Let's see what the impact of these has been, right? Maybe I'll go very quickly into this, but I think the biggest impact of DPI has been the ability to make these direct benefit transfers without any leakages in the system, right? I'll sort of link back to Nikhil Kamat's podcast as well, where Modi ji had talked about how like in sort of seconds you can sort of make these transfers, you can send out subsidies, you can send out DBTs, right? I think that's a big power that we have today. Also on the back of this, we can look at some of the newer initiatives as well, like ONDC for example, right? Which has been a huge boon, at least to mobility, right? And now there are more state-run mobility initiatives as well coming in. And then there is UPI. Of course, enough has been said about UPI about from us and others. So we thought we'll just sort of cover the impact of UPI this time around.
So I think on impact, right, with UPI and of course Aadhaar and what these, along with maybe the Jan Dhan account, etc., have been able to do is really make India, and I think the single best description I've heard of India today is as a digital welfare state, right? Able to leverage digital technologies, but fundamentally for welfare. And it's I always find this it's fascinating how we've been able to kind of do that, and you kind of have this kind of pick of the Prime Minister who's on the podcast talking about how he's able to kind of transfer money so fast, and that's clearly something that the government sees as a huge tool and advantage. Go on.
I think our finance minister also highlighted that we save about $4 billion. We've saved about $4 billion in leakages just by having this the JAM Trinity, as it's called, right? Your mobile, your Aadhaar, and your Jan Dhan. So taking this back to UPI, right? We looked at some of the impacts that UPI has had on the payments landscape. So one has been that UPI by volume of transactions today has overtaken and taken away market share from debit and credit cards in sort of this online payments ecosystem. On top of this, we're also seeing a slight decline in the number of ATMs and a growth in number of QR codes, right? And the third part of this is that UPI has this the larger theme around UPI is that 0% MDR kind of drives the way. And this is to drive a lot of the adoption, at least on the merchant side. But this has been taking out the revenue pools of payment service providers. And they really look at UPI and these payment initiatives as more of a customer acquisition cost. Then they have to offer them an ecosystem of other financial services. Most often it's lending. And we just try to take sort of peer-to-merchant transactions and apply that debit card MDR of 0.5%, and we actually noticed $2.5 to about $3 billion a year could be generated in revenue for these payment service providers.
Yeah, well, it's interesting that you mention it because there is a vertical SaaS company that I work with called Viscommerce, and Anurag, you would know, with all the vertical SaaS companies, fundamentally have payments as a big revenue and profit pool, right? The Shopify makes more money from payments than from SaaS. But unfortunately in India, you can't make it work because there is no revenue pool in, forget profit pool, revenue pool hi nahi hai, like, you know. So that's sort of the second order effects of having MDR set to 0, other than this one small exception that's made for prepaid instruments about 2,000 rupees P2M. Again, nuanced. But that's why everyone is a lender in India, right?
Correct.
Every fintech is a lender in India because payments, there's no profit pool to be made in payments. So it's particularly interesting, and perhaps if we can address some of this, then we might see a potential revenue pool emerging.
And
this covers our structural forces.
We have the big one, consumption, which we'll have Sajith cover. I think this is a section everyone looks forward to, and the India stack. So over to you, Sajith.
Yeah, so consumption is a particularly fascinating topic, and has to be, right, because it's also what is the single biggest driver of our GDP, and then there are some peculiarities related to that which I'll try and bring out in this section. So if you look at the consumption sector, it's got about 20 odd slides, and it's kind of broken up into about four parts, I would say. I think the first part's really to do with introducing consumption, looking at the consumption stack, its size. So we break consumption down into various constituent buckets. How much of it is like goods, how much of it is services, and how does the goods part, the retail part stack up, and so on. And then it looks at the size of the consumption economy, and it is a large one because it's 60% of 3.7 trillion. It's actually the fifth largest consumption economy by GDP, and it's also grown fast. But the truth is, when you actually look at it in per capita terms, it's not that impressive. We are roughly where China was in 2010. And that's sort of the interesting finding that comes from it. And there are a lot of stats that we quote on how India underconsumes on a variety of stuff, whether it's financial product, whether it's air conditioning, whether it's footwear, whether it's tourism, electricity, you name it. We underconsume on a per capita basis, on penetration rates, on all of this. And the reason for that is reflected in the structure of the Indian consumer stack. And we have this framework called India 1, 2, 3. Full credit to Mr. Kishore Biani for inventing it. And in his book, It Happened in India, that's where I kind of saw this first. But what we've done is to really study this deeply at Blume and fundamentally contrast, first of all, figure out the size of these classes, these buckets, then contrast with some countries which kind of give you a proxy for the size. So India 1 is about 140 million people, 35 million households, roughly $15,000 per capita income. I mean, give or take, because it's very hard to get these kind of cuts. And and this is really the consuming class which drives most of like startup world consumption, right? It is really the native sector for Indian Indus Valley startups. And that's about 140 million, and that's like a Mexico. And then there is India 2, which is the aspiring India, which kind of got created after Geo, etc. And UPI kind of now enables them to kind of participate. But they're typically largely consumers, not payers. Right? So and then the startups which specifically cater for that. Meesho, I would say, is like a canonical startup for India 2, etc. Or like, for example, Stage is kind of somewhere between India 1 and India 2, etc. So sort of this consumer stack has become like a famous slide now. Kind of lays out, and fundamental challenge is that we are too dependent on India 1 for our consumption rates. Really, the engine that drives the economy forward. A telling stat, 10% of India 1, takes care of close to 70% of discretionary spends. And when you take India 2, both add up to more than 100%, which means India 3 is actually dipping into their savings all the time. Okay. So this is sort of, I would say, like section 1, which is really to do with the fact that India underconsumes. And why? I would say section 1 and 2 are kind of covered. Section 3 is to do with the fact that while India 1 is a consumer engine, increasingly we're relying on it far too much. And we're not looking to expand this India 1, and it's not been happening. It's rather India 1 is deepening. They're getting richer, and they're beginning to kind of spend more monies, but that absolute number is not going. I think our look at car sales is a fascinating kind of slide where we contrasted how our car sales volumes haven't gone up dramatically. Like when we look at China's numbers in I would say like the 2000s and of how the car sales took off, or US in the 1920s, which was there when they were like the China of the of the developing world. So there was dramatic increase in numbers, but we haven't had those dramatic increase in numbers. Instead, what we are actually seeing is more expensive cars are getting sold. The share of SUVs has gone up to about half. It used to be like a quarter. So what we're really seeing is more and more examples of, I would say, not so much widening, but as much as deepening. Airfares and travel is a great example of that. We haven't had a dramatic rise in plane travel. But we are beginning to see a lot more spends on travel and people traveling abroad. So these are very trends that ideally something we need to correct, because India won't grow with a narrow base only. We'll have to widen the consuming class base. So that's what this that's what is really, I think, the highlight of the consumption sector. And then we have tried to look at, if India 1 is really the consumer engine and India 1 is deepening, and what does India 1's consumption have to say about India and how are they shaping India? So some interesting charts like this one about travel, which etc. But one about how new interesting brands are getting created, like like Amrit and Ultrahuman. Both are India 1 brands which are being accepted as global best products, right? And stuff like that. And I would say finally there are also interesting patterns of consumption like gated communities. India 1's preference for gated communities and how gated communities are becoming concentrations of affluence. So these are, I would say, findings that we tried to kind of dig into. For example, how big, for example, APR, Adarsh Palm Retreat. I would say like Adarsh Palm Retreat actually probably accounts for sales of certain luxury products more than any cities in India. Like like if you take a Meerut or a even like a Nagpur, Adarsh Palm Retreat probably sells more luxury cars, so, but yeah, it's hard to kind of get the exact data, but yeah. So this is sort of broadly how consumption is, and so sort of the key themes that we want to bring there are, consumption is a key component of the Indian GDP. It is growing. Overall it looks very impressive, but on a per capita basis, when it's divided amongst 1.4 billion Indians, it's not as impressive. A big reason for that is the nature of our consumer stack. The fact that there is a very small percentage, which we call India 1, driving this forward, which is not widening as much as deepening. And their spends and their consumption patterns are increasingly shaping the Indian economy in a certain direction. So that is sort of the summary of the consumption section.
What do you think was something that was very surprising to you versus last year? Was there anything that you realized? Like for me, the deepening bit was very evident because I am part of that. Not widening bit was very surprising. Like I thought like people are becoming more affluent, but what you're saying is that people are not becoming that affluent. And do you see that same pattern between India 3 to India 2?
Hard to figure some of these because I would say India 2, I mean, I haven't seen dramatic shifts in that. For example, what would be proxies for India 2 would be like two-wheeler sales, but two-wheeler sales haven't grown.
Correct.
Okay, you and I know given that we study the sector well, we know that they haven't grown as much. We also haven't seen a dramatic increase in UPI. For example, UPI is still stuck at 330 million users. That's the last data that I saw.
Correct.
And between India 1 and India 2, that kind of takes care. So I don't know if India 2 is expanding as fast. And I think the story of the last 2 years, 2 or 3 years has been that these classes have kind of got stuck a little bit at these sizes, and they're not shifting as much. But it's worth noting there's a parallel with Indonesia. Indonesia is strangely a country where the India 1 percentage has declined. Like it's scary, which is sort of, so I don't think that's happened in India. I don't think the percentages have declined as much.
Indonesia 1, you're saying, like the top of the pyramid.
They've actually had a decline in, It's scary because that's the key driver of consumption.
Okay.
So that's Indonesia, so we don't need to get too much into that. But yeah, as far as India is concerned, I would say my worry would be that it's not widening and it needs to widen. And it's only and may have widened by a little bit, but like I said, it's not widening as much as it's deepening. It's deepening faster than it's widening, and that I think is the general worry that I have. Yeah.
One of my favorite slides and charts which depicts what you're saying very well was when we looked at number of tax filers versus the average tax paid by them, right? That
correct.
The staggering difference in that over this period of FY13 to FY23.
Correct.
But a very small increase in the number of taxpayers itself has been very interesting.
Absolutely.
And I think with the new budget, we'll see that number go down even
Absolutely.
more.
2.8 crores of taxpayers, which we are going to kind of see that number decline further, and so. Increasingly, the government is going to have to rely a little bit more on indirect tax to kind of take care of its requirements. But yeah, that's a telling point. Yeah.
So now we start on the second part of our report. That's basically Indus Valley. So first part of the report we spoke about India and all of those things. Second part of the report we talk about Indus Valley, what is happening in the startup ecosystem, what is the state of the union of startup ecosystem in some sense. So this is a regular section in our report that comes in every year where we are trying to take a stock of what is happening, what is not happening. Let's look at a very global lens, very macro lens. When you look at a very macro lens, the one liner is that US has bounced back, China is in flux, and India is on the similar trend lines. So that's the net summary of a global macro lens. US, thanks to AI, is becoming, it's back to 191 billion versus 152 billion, but the point is that it is going strong. China is in the 4th year of decline in venture funding, and India is seeing signs of revival in some sense. And let's say when you double click on India, right, when you try to understand what is happening in India, because that's our job, the one thing that is that it's 2023 repeat, but in some ways slightly different, but essentially a repeat of 2023. The trend line remains same. So the way we look at Indian funding is that 11.2 billion got funded, 11.2 billion was deployed in 2024, can be broadly bucketed into 3 parts. That's seed, early and late. Seed has remained same. Early and late have seen a slight uptick, and we'll talk about this. So basically the way this section is going to roll is that we'll talk about each one of them, because we feel that's a very important way to describe Indus Valley and understand Indus Valley. So let's start looking by seed funding. So the interesting trend line, and I think Sajith has spoken about it for a very long time, I think, like even before Indus Valley, that the larger checks have become more common. There are fewer companies raising a seed round, but the ones who are raising a much bigger round. And
some of that is due to, I would say, that 2 tiers of the venture market or the founder market.
Correct.
People talk about the venture market as if it's one, but I always felt there are 2 markets there. One is like the first time founder, like the less experienced founder, and then there is the fluent founder, as we call it, the fresh founder and the fluent founder. And the fluent founders, like operators from high growth startups or second time founders, etc., they typically tend to get funded, and they get funded, they get these mango seed rounds, as we call them. Yeah. So I think that's the key thing I think folks need to understand. There are 2 markets operating here effectively.
Correct.
Yeah.
Correct. And that's the mango seed, right? Let's say the beauty of Indus Valley is that we can show it in charts. So if you look at it, right, so between let's say 2017 to 2024, we'll talk about 2 things, like number of companies, percentage of companies raising less than $1 million versus companies raising more than 3 million as their first check. So the striking thing is that when in 2017 it was less than 10% of the companies were raising a round larger than 3 million, now that is 50%. So 50% of all the funding goes into companies that are raising larger than 3 million rounds. And the same thing, if you look at it from a smaller check lens, whereas 60% of all funding was going to companies raising less than $1 million, now that has reduced to 1/3 of that. So that points to it actually proves the lens that okay, larger rounds are happening, more seasoned founders are coming, and people are willing to bet. We are also betting on them only.
True. I think this fascinating thing is from less than 10% of overall funding rounds, 3 million plus round is now 50%.
Correct.
That was telling and dramatic.
Correct. Absolutely. So that talks more about the trend lines being the same in a broader sense. And also we cover micro VCs in this and how they are fueling the ecosystem. But now let's go into the early stage part of it. So let's say Series A, Series B. One liner, the check size remains the same, fewer rounds. The consequence of fewer rounds is that companies have to wait longer between rounds.
Yeah.
So that's like the one liner here.
Yeah.
Effectively, funding wise, if you look at it, there's a small delta difference. We are higher than what we were 2023, but let's say by 200-300 million odd. The striking thing, two facts is that let's say 30% fewer companies are raising a Series A and Series B when you compare to 22-21, because 22-21 can also be called as an anomaly in terms of how much money was deployed. So that's the thing, that 30% fewer, but the rounds are not getting smaller. So that means what is happening is that a company, if it is raising Series A, it is taking longer to raise Series B. And that if you look at the third chart in that slide, what you will see is that what used to take 21 months for a company to raise Series A to Series B in 2017, now it takes them 30 months.
Wow.
So that's like 9 months.
Nearly a year longer.
Almost a year longer. And we see similar in Seed to Series A also.
Other one I really liked and is this time taken between rounds sliced by whether you are a seeds backed company and a multi-stage fund backed company. And I think what a multi-stage fund does is it kind of is able to invest in seed rounds and is possibly, what this data says, is able to support them readily. And then the choice it has is then between, do I support my company or do I support another seed stage backed company? And what the data tells you is, not surprisingly, they're choosing to back their company. And perhaps that's what the data says. I can't think of any other cut for the data because it's fairly dramatic in 24. The average time taken from seed to Series A for a seed fund backed company is nearly 3 years, but it's less than 2 years for a multi-stage fund backed company. Wow. So that was a fascinating chart that emerged. Yeah.
Wow. Correct. And the striking thing also to me is that has not increased for, let's say, a multi-stage fund that has remained, the time between funds that remained the same in the last 7-8 years. Whereas a seed fund, it has increased. And that's also obvious, right? Fewer rounds are happening. So the money deployed is less. So the time between round increases.
You can afford to be choosy.
Correct.
Correct.
And building on that, so let's say if you, the third component of the funding, so that's seed early and then there's late. And I feel my observation has been that late stage funding drives an ecosystem because everybody is feeding into them.
It's typically the larger portion anyway.
Correct. Larger portion anyway, and it shows you the health of the ecosystem in some sense.
Absolutely.
Like how strongly is the ecosystem working. And the thing is that we are doing better than 23, but we are nowhere closer to what 2021 was. So let's say in 2024, we did about 6.5 billion of late stage funding. Whereas in 2021, it was closer to 26-27 billion. That's the amount of massive difference that we are seeing. And also in the funny part is that also if you look at, so let's say the late stage funding to overall funding is about 59%, right? In a market like US, it's about 70-75%.
Got it.
So that tells you that, okay, there has to be some delta difference that we have to cover up so that companies are able to raise late stage funding. And this we are also seeing in companies going to IPO sooner because of the absence of late stage funding that we'll cover later.
I think this would also tie into this narrative we had last year about how SME IPOs are the new growth rounds, right? Because you kind of need it.
Correct.
Yeah. So what I feel it's emerging is when you look at these three together is there is no overall big difference between 23 and 24. Seeds come down by a little bit or thereabouts, and the other two have grown a little bit. What we're really seeing is not as many rounds and a lot more choosiness and a lot more intentionality, if you want to use a generous word, on behalf of the later stage investors. And that also means that if you're a well-funded company, you're fine. You have money. But if you're not a well-funded company, then you really have some concerns emerging. But
correct.
Yeah.
I think my one last takeaway would be that moving towards efficiency. The whole ecosystem is moving towards efficiency. Larger companies are raising smaller rounds because they're getting more efficient. They want to get more efficient. All of that. And this ties into a very fun or a very buzzy topic of unicorns, like those mythical creatures. We are the third largest unicorn factory, and we wanted to cover that because it's correlated to the late stage funding thing, like how many companies are graduating to become bigger and bigger. And so we are the third largest. We have 117 unicorns versus, let's say, China has about 250 and US has about 1,000 odd. But the broad point is that we are the third largest. We wanted to see what is the state of our unicorns. Sajith, would love for you to chime in and tell me, like, what did you realize when you started studying unicorns, and what was your main takeaways?
So when we looked at the 117 unicorns, I think we wanted to be sure that we were the third largest and not maybe the fourth largest, etc. Now, we were not able to go and look at every company after us to see if the unicorn count was still maintained, but we could look at the Indian companies. And what we really found, and this is an interesting exercise, thank you and Dhruv for doing this, is really that maybe we don't have 117 unicorns, right? And maybe we have, what your feeling is, what we have 20 less or 25 less?
25 less, 91.
91, so about 26 less. And I think what's happened is that there are quite a few set of companies which kind of come under the unicorn category, but they've dropped out. Byju's, for example, is an obvious one. Okay, then there are funds which have shut down since then, like Hike, for instance. Then there are ones which are going through a fair bit of crisis, and once we know for sure that existing investors are marked down below $1 billion, like Good Glam is one, Pharmacy is another, etc. So now we can't show every single one, but at least the ones which are publicly kind of announced, we've shown them here. But fundamentally, there are about, I would say, 20 which are privately held below $1 billion. Then there are 3 in, I would say, in the publicly listed ones which have dropped below $1 billion, like Mama, Black Buck, etc. And then there are 3 in the acquired or which have clearly fallen below, like Shop Clues, etc. So what it tells us is, I think the unicorn count needs to be looked at. And I think 91 perhaps is the right unicorn count. Yeah, but it's sort of fascinating. But yeah,
but just a positive spin to that is that, let's say 2023 we had 2 unicorns, 2024 we had 6 unicorns.
Yeah,
so that's the trend lines are
we'll
shifting.
See more unicorns, and particularly heartening to see the numbers slowly go up, and we'll have more. So I have no doubts that we'll have far more coming up. And but I would say the other one is really to do with, I think the other heartening thing is really to do with the IPO and the IPO process, which sometimes needs that companies need to flip their way back to India. And I think you've done a little bit of work there, right?
Correct. So that's a very exciting thing, where basically 10 years back or 7 years back, companies wanted to register in US and do the business there. Now all of them are reflipping back to India, even though they have to pay huge amount of taxes to do that. So PhonePe is the canonical example. They paid $1 billion in taxes, which makes them amongst the top 10 taxpayers if you compare it that particular year in terms of institutes that have paid taxes, even higher than Axis Bank total tax tally. And you can see in different cases, let's say Razorpay, Grow, all of them have used tax bills. But the overall point The net point is that companies have to reflip back because of regulation, because of strong public markets, and because of them realizing that India is the market they serve.
Got it. It's interesting that PhonePe is not, it's owned by Walmart, but Grow, Razorpay, Zepto, all are YC companies. and I also noticed that you have this tweet thread or tweets by Anu Hariharan talking about this. But you know, I must say, we must give credit to YC and the amount of tax YC companies are paying. Maybe Gary Tan should be nominated for a Padma Shri, right? Yeah. So yeah, back at you.
Yeah, so that's the reflipping part and the reason why companies want to do it. The last trend when we cover Indus Valley at a macro lens is about venture debt. It's about how something or how venture debt is basically debt that is given based on the equity of funding that you raise, was not present or was very small, less than a percentage. 2017 has now become 11% of total funding that is deployed. So let's say this year we have deployed 11 billion in venture funding, closer to 1.3 billion, if I'm not wrong, 1.3ish billion that was deployed in venture debt in 2023. So that's like a very striking story of how, as the number of time between round is increasing, companies have to rely on outside debt to support themselves, and that is creating its own consequences.
So this then ties back into that late stage funding or the absence of late stage funding. So you do have to turn to these alternatives now.
Correct. And these alternatives have their consequences. Like they are tied to your equity funding. They have a lot of different consequences and preferences that come into picture.
Got it. Yeah, I think on funding, late stage funding, and I think innovatively, I think it's a good segue into the IPO segment.
Correct.
And I think there we've had a fantastic year, I think, right? And it's really one area where India has outperformed.
Correct.
Not as good as the equity derivatives did, but still we are number one.
Yeah, number one.
Well. Yeah.
Correct.
Yeah.
So the IPO section, India again not as big as derivatives as you said, but the largest in terms of the number of IPOs. We have hit it out of the park. Around 268 IPOs have happened, around 90 of them being on the main board, and we have raised about these companies have raised about $19.5 billion. That's one of the highest in this world. And at the same time, the largest IPO ever in Indian history has also happened last year. That was Hyundai. That was also the second largest in terms of the world. The point, the net point I'm doing is that it's an IPO nation. Like companies are going public, all sort of companies, startups, non-startups are going public because there's a huge reception to public companies. And it's not like only large companies, only Hyundais of the world are going, right? There are smaller, it is becoming more and more accessible. So as a stat, like 37%, the median market cap has reduced by 37% from 2018, while the median revenue at the time of listing has reduced by 42% since 2018. What it means is that smaller companies are going public and public markets are receptive to them.
So what's kind of interesting is, if you look at, for example, the number in the chart, in 2023, and I think we'll have the numbers for 2024, it may not be very different. About $100 million is the median revenue at listing, right? And so there'll be companies lower than this actually. Whereas in the US today, you can't go for an IPO unless you have $500 million at least, right? And so what it tells us is the barrier to have an IPO is much lower in India. It has been coming down from almost 200 million. At that exchange rate, it would have been maybe more than 200 million to about 100 million now. And that's, I think, welcome. And market cap also, I was very fascinated to notice that it's not it's barely 300 million, like, you know.
Correct.
So that's welcome, and it's come down a lot, like,
Correct.
you know, and it probably come down for like probably 600 million to 700 million to about 300 million. So it's heartening to see, and sort of what it means is, even as like an SME IPO is something I think we'll chat a little bit about, but there's a mini IPO market in India. And while there's a large IPO market, there's a mini IPO market, which is not there in the US, for instance. And that's something that's interesting.
Correct.
But
And that ties into the retail participation as well.
Correct.
And also this lower barrier for IPO also ties into the flips that are now happening with our startups, right?
Yeah, all of this is coming into place where, and late stage capital is available less, so you go IPO and all of that. And it's like, though the IPO story feels like from a startup lens only a last couple of years phenomenon, but we have had a history of IPOs. So what we looked at and what was striking to us also, like 160 venture-backed companies have IPO'd. Though 2/3 of the market cap has come after 2021, but there has been quite a few of companies that have IPO'd, let's say Naukaris of the world, they have come in after, before 2011, and that we have had a thriving ecosystem per se. And that also, let's say, when you look at the last 3 years of IPO and how have those companies done, and what has been the constituents of those companies, I think the one way to summarize it is that smaller companies have done much better in public markets because they have constantly compounded in certain sense. So let's say out of the 80 odd companies that have IPO'd in the last 3 years, about 66% of them were less than $1 billion at the time of IPO. So it's not like the only Zomatos of the world can IPO. All companies of all sizes can IPO, and actually if you're smaller you do better.
Because I think the market acts as a forcing function to kind of do better.
Correct. And that's what we have also shown in the other two charts here, like how the number of companies are IPOing, how they've performed. And surprisingly, the smaller companies have, even though the market has been in flux over the last 2, 3 or 4 months, they've outperformed the larger cap companies in terms of performance. Like they have seen 25% gain from the time of IPO to now, whereas the larger companies have seen a drop comparatively to their time of IPO. And this ties into the smaller phenomenon that we are talking, mini IPOs that Sajith spoke about, talks about one more interesting thing, that is SME IPOs. So for those who don't know, basically there are two types of companies. One is main board, those are larger companies, a larger revenue, and there's SME board, where companies who are not even at that scale can go public and then graduate to a main board sort of a company. And that has been on a tear. Like the amount of money that these companies have raised have been about 8,600 crores or roughly $1 billion. Whereas let's say 5 years back, that was around 200 crores or something like that. And that's actually surprising, and that's actually a very nicer way to say that, okay, more and more companies are going IPO and it is accessible. And they're performing really well. So like let's say if you look at the returns, IPO index versus BSE IPO index, they've performed 5x better than a BSE IPO index. And that has also, and one of the things that Sajith also keeps talking about SME IPOs and all of that, would love for him to also chime in over here, like what does he think, what is happening?
Yeah, I think you covered much of it. I'll talk about a couple of points. I think I would say a certain type of VC-backed companies, which are fundamentally well-run, solid companies, maybe not growing at an incredible clip, and you're not as large enough to get interest from the main boards. The SME IPO is actually a fantastic route, and we have had a couple of our companies, E2E and Infoleon, which have gone through this route. And E2E, for instance, today is at 4,000 crores market cap, but in the middle it had almost reached, I think 7,000, 8,000 crores market cap. And when it was, I would say, like when it went for an IPO, it was barely at some 60 crores revenue, so I don't think it was particularly
60 crores in market cap.
60 crores in market cap, sorry. Yeah. So when it went for an IPO, it was at a market cap of 60 crores or so, right? And it's almost like 70x today.
Correct.
In the middle, it had gone to 100x of that.
Correct.
And so it's been an impressive journey, and sort of what it tells you is, and E2E, for instance, has now migrated to the main boards. What it tells you is there is a path which can take you from an unlisted, well-run, maybe not so loved venture-backed company to an SME IPO to the main boards. So that I think is a heartening story. And we also have this case study on E2E, which we kind of put. And finally, I think we also put these guidelines for founders mulling on an SME IPO. We jokingly put this slide, and as it turns out, maybe not so jokingly, that the SME IPO is like the new growth round. And that's another way to kind of look at it for a certain type of company, not all companies. So I think these are the points I think I wanted to cover in my
Correct, and I think that summarizes it really well. So essentially what you're saying is that IPOs have become the way companies are raising money in absence of late stage capital, and and it's doing really well. And with
We're
that,
fortunate to, I think, have a mini IPO market in India.
Correct.
Okay, unlike the US, for instance, and we have to be grateful for that. Yeah.
yeah, and so that leads us to a very, so every time in Indus Valley we look at a couple of sectors that have done really well, and one of them that NS is going to talk about is going to be AI.
So every year post launching one of these reports, we collect a lot of feedback on what our viewers want, any criticisms, feedback on what they want in the next report. The most widely requested section was, of course, one on AI. And while the India AI story is still a developing one, globally a lot has happened, and we can't really shy away from addressing this anymore. So a good way to start this off is that an Indian company was present at the birth of OpenAI. Infosys were early donors of OpenAI when it was a non-profit org, right? But when OpenAI actually launched to the world, to the public, the big question, at least in India, was, do we need our own LLM, right? This was the raging debate of the time. And as a consequence of this, a lot more of the funding went towards the application layer, because it was generally thought of that the funding pool to actually build an LLM in India didn't exist. Then this DeepSeek moment happened, right? And it shook everyone in India to their core. Our founders got this much needed jolt, and a lot of them have now stepped on into roles that sort of prioritize building LLMs or SLMs. We have Paras Chopra, we have Sridhar Vembu, who said he stepped down as CEO and he's now chief scientist, right? So these are some of the DeepSeek kind of second order effects.
Correct. Reactions to DeepSeek.
Reactions to DeepSeek.
Given us confidence that we can do something. Yeah.
Yeah.
And it seems like the government also has gotten into the
Correct.
act. Yeah.
Yeah. I think there's been a lot more grants, there's been a lot more funding set up. They've also brought in 18,000 GPUs and lower costs for accessing these GPUs for some of the more exciting AI teams in India, right? And maybe something, some massive breakthrough is happening as we sort of have this conversation and put this out. And again, another big question underlying all of this was, why was India not able to do what DeepSeek managed to do, right? I think what we take for granted is that China actually has been leading the world in terms of AI research. Initially, it was thought of as volume of papers, but of course, they did prove us wrong on that front. And while India has this very large AI talent pool, they actually don't work in India. All of them work in the US, right? Which is why we need our technocrats to sort of take on this mission and say, hey, we're going to bring that talent back in. We're going to take this challenge and build this, right? Because we've seen in the past that India does very well with frugal innovation. India does a lot more with a lot less. We've seen that with UPI. We've seen that with many ISRO successes, which really put us on the global stage. And with sort of this burgeoning market of data centers, with the government sort of coming in with this government-private partnership, which has been a successful playbook for India in the past, and also with sort of providing access to these GPUs at lower cost for companies, I think we're creating this ecosystem where we have the chance to actually be a part of this conversation again and really make some massive strides on this front.
Yeah. Although on that note, what's your take? When are we likely to see in months the next India's LLM, India's foundational model?
I'm more on the optimistic side. I believe that DeepSeek has shown us a way, and there is a lot of possibilities in application layers that we can do really well in. So I'm hopeful 2025 will be very great for Indian startups in this regard.
Yeah. I don't know if 2025 will see one, but I think by 2026 we should see one. And but it's interesting that like there's so much excitement around this in India. And I think we'll get there, but So
I think we're all optimistic, but I don't think I'm going to go on record with like a timestamp on when this is going to happen. But yeah, I'll sort of lead Anurag and Sajith to sort of take over from here on what has actually been the biggest developing sector for India in the last couple of years, which is quick commerce. Yeah, I know both of you struggle to actually figure out how much we can actually put in the report. Otherwise, I think we would have a quick commerce report on our hands. Yeah.
Thanks, Anas. So basically, the quick commerce is the hero sector of India that has been driving so much innovation, and it's also India first. It's more like what UPI did for payments. That is what quick commerce is doing for all of e-commerce. And I think the best thing that got stuck in my mind was from a CLSA report by Aditya and was written by Aditya Soman, was Zomato is India's CapEx story. And that summarizes it really well. So broad headlines. So I think this part is broken down into four broad buckets. So first I'll try to explain that, okay, it has grown, why it has grown, what are the implications of its growth, and how far can it grow? Like that gives you an understanding of what is happening, and we've covered it in much more detail. And this is like a run through of what our main ideas are here. So anybody who says quick commerce is not big enough is living under a rock. It has grown 24x in the last 3 years, now doing about $7 billion of order value. It is roughly 25 million people use it every month. That's not unique, but as a comparison, that's about 40 million for food delivery. So don't be surprised if next year or next to next year it will surpass food delivery.
There's actually a chart which I think, I don't know who shared, but I saw it, which said the QCOM DAOs have overtaken food delivery DAOs, so daily active users. So it may have already have happened.
Yeah, but that's amazing how it is growing, and it's growing at a massive speed. So let's say Blinkit is getting to, let's say, 1200 odd stores in a year by this year in dark stores, and all of these players are present in more than 60 cities. And all of these players would also have 1000 dark stores. So that's the massive amount of capital being spent over here. And contrary to what people believe, it's not like everything is happening through an unprofitable mode. If you look at, let's say, two examples, like one you look at, let's say Zepto. Earlier it used to take 23 months for a store to break even, now it takes 8 months. Blinkit is public markets darling, Zomato, where it has turned operationally contribution margin positive on Blinkit. Is about 3% or something like that. And that shows very accurately that, okay, this business model is sustainable. Sajith has his own reservation on how big can it be, but it's sustainable. It's not a very cash burning thing. And we go into depths in the slides that you can also see later of how it earns money and how it spends money. Now the big question is, why did quick commerce work? And the answer is because modern retail never worked. So if you look at India has roughly about 6 to 8% of modern retail as an overall trade. Whereas if you look at US, it's majority modern retail driven. Now why is that? Now I think there are multiple reasons, but essentially you can summarize it in two things, that our houses are smaller, so you cannot stock up, and we don't all have cars. That means that you cannot travel far away to get something. And the third effect is also that there's a lot of traffic, so the traveling time is very high, which has caused modern retail to not grow. And that surprisingly leads to why quick commerce works. Quick commerce has three things. It has low labor cost. It is supported by high population density, which also leads to the lowest rider cost to AOV. So what I'm trying to say at a very simple level, it costs very less to deliver some item. Because of high population density, you can deliver multiple items, and the overall cost of delivery, that's include fuel and everything, all of that is one of the lowest in the world. That is causing quick commerce to be sustainable, whereas it was never sustainable everywhere else. And it has a lot of advantages, right? You know the advantage. I order something, I get it in 10 minutes.
Yeah, there's actually a wonderful saying, and I came across in an Adit Palicha podcast, where he describes some investor in his company or some well-wisher mentor uses a word called density is destiny, and he talks about quick commerce in that light. And so I think density has a lot to do with it. I think you've touched upon all of this. Costs is one. The density that India affords, like maybe China comes close to this, of having so many people packed together in one neighborhood, I think that's a factor as well, which you've covered. Yeah.
Correct. Yeah, absolutely. And we have also shown it in terms of how dense our cities are versus everywhere
You
else.
compared it to 5 cities. That's a good chart. Yeah.
So basically, it's faster, it's cheaper, it has wider selection. You have 5x or 6x depending on where you're ordering from, SKUs compared to, let's say, a Kirana store.
So that's been an interesting development. I must tell you that one which took me by surprise has been that we all spoke about TAM, and one way in which these guys have expanded TAM has been by expanding, especially Blinkit, the SKU count.
Correct.
And they have been the most aggressive, and I think Zepto kept it a little bit narrowly focused on grocery and food, and maybe personal care products. But these guys have been far more aggressive on expanding to toys. They offered printing services in the middle, and what have you, So yeah.
Correct, and that played out really well. So that essentially summarizes, quick commerce has grown really well. The reasons it has grown, and now the implications. When you look at the implications, what have started to happen? One of them is that more and more quick commerce is not only groceries. It is much more than groceries.
Sure.
For Blinkit, as Sajith pointed out, right, they have expanded so massively. It's 40% of their gross order value, and you can see it. You see it in various different ways, right? They have launched electronics. They have returns. They have launched their own private labels. Zepto has its own meat company called as Relish that is doing about 150 odd annual revenue and all of that, 150 or 180 crore revenue. And they're moving to higher and higher margin products. And that's the beauty of quick commerce. Like, let's say Zepto Cafe that can operate in the same dark store, doesn't have to pay commission, can be a top-up order that increases the average order value.
So there are a few themes there. Let's kind of just bring it all together. One, there's been quick commerce is growing. B, quick commerce is not as cash guzzling as maybe some other industries have been. The contribution margins are still low single digits, but at least they're positive. The other one has been to with really about them expanding the SKU count, focus on private labels, especially led by Zepto, with a view to improving margins. Okay. And the other one has been, I would say, to do with number of services. So then there is, for example, ads as a service, as a revenue line, which is kind of emerged as well. Zepto Cafe, which you mentioned, was particularly fascinating because they're able to kind of leverage their own dark stores better. So what I'm seeing from all of this is a desire to enhance TAM, a desire to enhance margins. These are really the key pillars through which I think quick commerce is kind of growing.
Correct. Correct. Absolutely, and everything is becoming quick.
Yeah,
that's the theme. Everything has become quick.
Yeah. So not only are, I would say, like the forcing, I would say, like Big Basket went from slotted delivery to BB now, which is their quick one. Then, for example, the likes of Amazon, Flipkart started Flipkart Minutes quite aggressively. The likes of Amazon is planning to start, and then of course even Mintras of the world, they've launched like quickish delivery. Like Nykaa is talking about same day, few hours delivery maybe. So everything is becoming quick, and India is becoming a quickish commerce country. So
and new competitors are coming in.
Yeah, absolutely.
That's amazing how innovation is happening in this space.
Okay, so what next?
I think a couple of themes to touch is that FMCG, right? That has been one player that has not leveraged e-commerce that much earlier, but is seeing huge tailwinds when it comes to quick commerce. So, like a headliner is basically HUL gets 10% of all its ice cream sales from quick commerce. Dabur gets more than 30% of its sales from beverage sales from quick commerce. So like these brands, which are humongous, are also getting a considerable amount from these quick commerce players. And they are doing, like it is also changing how FMCG works. The packaging is changing, it is getting more premiumized packaging and all of that. but it also creates a question that does it erode the biggest moat of FMCG brands, that was distribution? Now it becomes a fair playing field where you have to compete with all D2C brands. That's a question, and that's a tweet that Arindam Paul also explained, like, okay, what is happening here, and maybe quick commerce is its frenemy rather than a friend.
I thought it was a sharp tweet, and I think what it fundamentally referring to is that in the West, FMCG, they call it CPG, consumer packaged good brands. It's not easy for them to as in, like, to fight with modern retail, which are these, like Walmart itself is, I think, more than 10% of US grocery sales. It's pretty large, I think. I'm not 100% sure. And so on and so forth. Crogers, like Costco. So they're all significant players, and here in India, FMCG hasn't had to compete with modern retail. DMart is the only one really who's anything of note. So for the first time, they'll now have to kind of maybe compete with like largest players in their space, and that'll be interesting to kind of watch. And I think frenemy is the right word.
Correct. And there's just a couple of more themes here. So one is the D2C brands. They're actually seeing a lot of momentum where they're getting new types of audiences which they were not getting earlier on quick commerce, smaller cities, tier 2 audience, all of those. We also show one brand, we highlight one brand and how it has performed. We have other things also that showing that D2C is getting a lot of momentum from quick commerce. It is becoming a level playing field where they can actually market in front of an FMCG brand as well. But the thing that we speak about less and we are more concerned about is Kiranas.
Okay.
Like, how have Kiranas been impacted? Because it's a direct, like, people have stopped, like, let's say for me, for example, I've not used Kirana since a very long time. I generally just quick commerce everything.
Sure.
And there are some effects that have started to show up. Let's say the numbers, like 2 lakh Kirana stores closed last year, which I think is roughly 1 lakh affected by quick commerce areas. And you see Kirana owners being hesitant. We spoke to a Kirana owner. He was like, my home delivery volumes have reduced by 90% over the next between last 3-4 years and now, because people are just ordering online and they have much higher selection, right? I want a specific sort of dal. I want a specific sort of something which a Kirana store doesn't have. And that's causing an actual problem. Like, will Kiranas exist? I don't know. What are your views?
I don't think Kiranas will exist. And I think, I'll be very honest, and maybe at some point we should also talk a little bit about, use this as a stepping stone to talk about, is there a lot of irrational exuberance about kind of quick commerce? So both are interconnected. I think Kiranas will exist because not every part of India is conducive for quick commerce. As we've seen with quick commerce needs a certain amount of density, needs a certain amount of affluence, and of course needs sufficient amount of riders, etc. All of that. So the Kiranas which are kind of in urban areas, in slightly affluent areas, which are very quick commerce friendly, will struggle. Okay, I have no doubts on that. How many of Kiranas have shut down because of quick commerce? You postulated a number. I don't know, but I do think many are affected. There's no doubt on that, as we've ourselves seen from this kind of study that we did. I would say, if you are the Kiranas that are outside the quick commerce friendly zone, they would not have as big of an impact. Okay, and now yes, to what extent they'll get affected, how much of this thing, yes, they will get impacted, but there may not be as much impact for it to all shut down, I feel. And so now also I spoke about areas and quick commerce friendliness, and I think that's kind of something where we try to do a fair bit of work. We looked at two kind of reports. There was the one from Bernstein, which looked at the number of pin codes in India, which where, I mean, he wasn't looking at it from the point of view of quick commerce friendliness, but which were reasonably affluent. And there are only 5% of pin codes in India out of the 19,000 that we have, which have at least 5 organized stores and above. Like Domino's could be an organized store, Manyavar could be one, whatever. It could be like a Kalyan Jewelers could be one. But only 5% of pin codes which have 5 and above stores, 20% have at least one. So there are only 4,000 pin codes which have at least one organized thing. Now, if you say that maybe that's the ultimate TAM for quick commerce, but 5% is sort of the core TAM, like, and that means you have like barely 1,000 pin codes. And even if you look at, for example, 6, 8, 10 stores, you're looking at about 8,000 stores. Then there's also another interesting study by HDFC Securities, which actually looked at the districts in India, and they found that there are only about 63 districts out of the 780, which meet an affluence criteria. Okay, and what they looked at is people with the district with per capita income above 1.5 lakhs, and at least density criteria, more than 500 people per square km. There are only 63 districts. Now, these 63 districts, how many can they support? Maybe like we'll have to kind of see maybe about, and there'll be, again within the 63 districts, there'll be urban conurbations, etc. So I think overall, I would say, like, I think what we're likely to see is some realism about dark store economics, but even for Blinkit, it's only the, like for example, beyond the top third of their stores, some of the numbers drop dramatically. And in the analyst call, he said that 8 cities account for 80% of their volume. So you're right, they're in 60 cities, but many of the cities are long tail, and how many orders they're bringing, we don't know. So I would say, I would counsel a little bit of healthy skepticism. I think what I've noticed typically in India is we see a lot of categories which take off suddenly, but then taper off. Food services is another one. We've been here before. So I would say I would be a little cautious on, I would say it is an exciting sector, but will it, for example, take over entire e-commerce? I don't know. Okay. For example, I've seen there's the same gentleman who you mentioned from CLSA. He's done a DCF which kind of projects out the numbers to FY49. FY49, that's 25 years from now today, right? So that's the kind of data that I've had to kind of do to get projections. So I would say, but to summarize, I would say quick commerce, exciting sector, high growth, okay. Reasons why it works in India: density, affluence, rider costs, etc. It is that it's growing with two broad levers or vectors. One is along the TAM axis, more and more SKUs. One is along margins. So, for example, private labels, for instance, adding ads as a vertical, and so on. Implications for D2C brands, positive. For FMCG brands, questionable. Kirana, man, terrible. Like, but will it continue like this forever? I don't know. So on the store count, there just isn't as much geography that's amenable for quick commerce as I thought. Second, on user count, we have very concentrated affluence, India 1, and then there's this Kunal Shah tweet which we have put about 10 million users, etc. So I think beyond the top, 10% of India, the numbers fall sharply, and we've been seeing this food services actually. A lot of these deliveries, it's ceiling. So I'm not as exuberant, but and I think there's a lot of money that's going into the sector, and I think that's it's in the interest of many people to be extra buoyant about this. But I would say I would be a little more cautious, skeptical about this taking over e-commerce. And I think we'll start seeing a lot more competitive dynamics from e-commerce guys. They're not going to sit and have their lunch taken away. So we're in for some interesting times, and let's see how this shapes up. But all in all, a particularly fascinating sector. It was a great exercise, kind of putting some of these slides together. Yeah.
Correct. And now I think it's a very good segue. Then we move to playbooks, like 2 playbooks that you guys are going to cover. We have, I think, 4 playbooks in the whole report. 2 of them that you guys are going to cover. Over to Sajith to cover the first one. And
yeah, Anurag. So there are 4 playbooks, and I think between NS and I will cover one of the playbooks each. And I think the playbook that I'll focus on is the India 2 playbook. And here, what I've done is really to look at sort of a family tree of India 2 playbooks. And so there was a historic OG playbook, as I call it, which is really take what worked in the West, bring it to India, right? And for example, I think Ola Auto is like a canonical example. Ola is basically ride share, but ride share for India. So you have cash and you have auto, and sort of like, and you want to make it appeal to the mass market. Similarly, ShareChat, which is like Twitter or Instagram for vernacular users. But I would say that's sort of the OG playbook, and there the challenges were the cost base of many of these was much higher. And one of the interesting things I've seen is the cost base of the evolved playbook folks, which is really you're fundamentally doing the same thing, but you're engineering the products in a very different way. You're not taking a product designed for India 1 and bringing it down. You're actually fundamentally rethinking many aspects of it, etc. So Rapido, for instance, is a much lower cost base, much fewer people than Ola, for instance. Similarly, Stage, and we've actually got an interesting slide on how Stage engineers its product to have lower costs. For example, when they write a script, they don't write large crowd scenes into the script. They have much fewer people. So they don't have, the sets are not large. They're intentionally designed, right? The small things that they do. Like, so when they get a script which calls for a big crowd scene, they actually ask him to rewrite it. And so on and so forth, right? Like, yeah. So, and then there's a very interesting, what we call emerging playbook coming up. And emerging playbook is what we kind of, for example, see with like a Friend or Astro Talk, where you're fundamentally rethinking what the product is designed to do itself. Like Friend is an example I've used in the last report, where you're saying, look, Friend, you could think of Friend as Tinder for India, but objective is not to get dates as much as to spark the first conversation, right? Which could lead to a date. So they're saying what is the job to be done that we want to do, and it may not be dates so much as it may be conversations, and they're really going deep into what the customer wants, what the customer's concerns are, and then trying to solve for it. One way I like to think of it is as saying that India 1 products are designed to be very efficient at converting bottom of the funnel, whereas India 2 products have to be intentional about creating top of the funnel. Okay, so those are ways in which I try and look at it. It's simplistic. And we also seen kind of an interesting set of, I would say, along with playbooks, core features emerging. So a lot of the India 2 products are about voice, and they use microtransactions in a very sharp way. So we've given the example of Voice Club, for example, and what it means to have a particular revenue structure. Because when you have microtransactions, you tend to have whale users who are a few users, like 1% of their user base accounts for close to 50% of their revenue, and so on and so forth. So this is sort of the India 2 playbook, I would say, where what we're really trying to do is distinguish between, I would say, 3 buckets: the OG playbook, the evolved playbook, and the emerging playbook, and kind of see how they are kind of engineering themselves to kind of serve the market. Yeah. Over to you, NS.
Sure. I think, okay, so we've looked at the India stack over the years, and we've had an India 1, 2, and 3. This year we've come up with India 0, which is the Indian diaspora, right? I think this is such an affluent and influential class of cohort of people that we've given them this special moniker. And I think, Sajith, you've touched upon this before, but their remittances are much higher than actual FDI that comes into our country, right? The difference is
Never fails to surprise me. Yeah.
Yeah, the difference is 107 billion versus 70 billion in FDI, right? And so I think across the world, we're seeing people wake up to this power of India 0. They're the highest earners, they're the highest earning households in the US. Now Indian culture is sort of hitting the mainstream, right? You have Indian artists who are now on these world tours. You have shows like Never Have I Ever that talks about the life of diaspora. And you also have some of the bigger global brands that are introducing Indian food lines. Dating.com acquired Dil Mill, which was dating for South Asians. So a lot of people are waking up to the consumption power of this class. So it's about time India also wakes up to the consumption power of this cohort and starts building for them, right? So we've put together this framework.
It's a very easy way to expand TAM, right? One of the most affluent Indian communities, and who have an affinity to this country. Yeah, but go on.
Yeah, and for this very reason, we've sort of put together this framework. And the framework basically breaks down the different kind of people you have in the diaspora, right? You'll have high earners, low earners. That's one of the axes we've used. And the other is, do they have a high level of affiliation to country of origin, or do they have a low level of affiliation to the country of origin? Yeah. And what sort of comes to light is that there are 3 buckets that are targetable, which is your high earner, high affiliation. More often than not, they are buying products back home. They have family back home, they have ties back to India, and therefore they're investing in things like real estate. They're buying the brands in India that also speak to affluence in India, right? Because they still have ties here. Then there's low earners who have a high affiliation to the country, and here you want to evoke nostalgia. You want them to get a taste of home or some sense of home, whether it's film, whether it's music, whether it's your FMCG products, your snacks and your sweets, right? And then there's that high earner but low affiliation to the country of origin, and this is a interesting cohort in terms of some of the newer approaches that companies, both Indian and global, are taking to sort of attacking this market. And here what we've realized is you have to modernize what you're selling. You have to speak in that diaspora voice. You have to give them representation when you're selling to this cohort. And sometimes you have partnerships between global and Indian brands to sort of drive distribution here. So we've actually gone into some case studies for each of these cohorts. I'll let you go into the report to sort of understand these case studies a little bit more. But on the high earner, low affiliation to country of origin, we've looked at IndieWild, which has a large diaspora audience. And I think this is one of the more interesting case studies we have. It's about how they're using trends in global markets to actually have Indian tradition sort of carry on top of those trends, right? They took the hair slugging trend and turned it into a chumpy trend. And this is some of the interesting stuff you can do there. Then we have DLF, of course, 20% of their sales is from NRIs. Then we've also looked at Amul, who have been very clear that they're actually only going to target Indian households in the US. They don't want to be a mainstream product in the US. They're very happy serving just those highly affluent Indian households.
So Nachammai, every report is incomplete without a 2x2 matrix. And I'm glad you've done this 2x2 matrix, so it feels complete. But it's a fascinating kind of 2x2, and now I've thought of it that way in terms of affiliation to the motherland and income levels. And particularly fascinated by this unusual high earner, low affinity, low affiliation, which is basically ABCDs.
Yeah.
And we've been there for the second generation, etc. And I thought the IndieWild case study sounds very interesting, so yeah.
Does that bring us to the end of the report?
Yeah, I
Are we done?
think so.
Yeah.
This was a very short one. Maybe we should go
Keep
on a little
talking
bit
about
more.
the report.
Yeah.
I think we should leave for the audience to read some of it on their own.
Yeah, we should. Yeah.
Yeah.
So great.